Hello, everyone. My name is Jeffrey Kennedy, and welcome to Market Academy. Well, as you know, this week we've been focusing on impulse waves. We've discussed some of the guidelines, some of the rules, a few other things, but we're going to continue that discussion today. And specifically in today's discussion, we're going to discuss or talk about specifically fourth waves, and I'm also going to share with you one of my favorite timing techniques. And again, it's that trick that I call the Kennedy timeline. So let's go ahead and get started and just do a really quick recap of what we've explored this week. First, we took a look at, of course, the impulse wave, the idealized Elliott wave impulse wave, 5-wave move, one of the two types of motive waves, the other being an ending diagonal. We looked at the Fibonacci proportion, typically inherent to, again, an idealized version of an impulse wave. Then we also explored and looked at some of the variations of impulse waves, where typically we tend to encounter wave 3 as the extended wave of waves 1, 3, and 5. But again, on occasion, you will see an extended first wave or an extended fifth wave. And I discussed this in greater detail in Tuesday's episode of Market Academy. Then we also looked at a complexity or variation to the impulse wave, and that is the occurrence of a truncation. Again, a very rare development. I think in a given year, despite how many markets I look at, I really only encounter 2 or 3 truncations. So use this idea that the wave principle offers as far as the potentiality of a truncated wave. Use it judiciously, please. And then what we discussed yesterday was the right way and the wrong way to actually apply the wave principle or count an impulse wave. Remember, the diagram on the left is the right wave count, and you know it's the right wave count because this interpretation basically mimics what you see in the Elliott Wave Principle book written by A.J. Frost and Robert Prechter. The diagram on the right, even though it does adhere to the rules of the Elliott Wave Principle, it does not adhere to the guidelines of impulse wave development, specifically the guideline regarding proportionality. This wave 4 here is just simply way too big for the wave 2. And this kind of brings us into today's discussion. It's a good segue because I specifically want to talk about fourth wave developments because fourth waves can actually be kind of tricky. So I'm going to share with you all the knowledge, everything that I've learned over 30 plus years of counting waves, specifically as it has to do with wave 4. Okay, now on the diagram on the left, you see 2 wave 4 extremes. Wave 4 here, and then wave 4 here. The first wave 4 ends at the 618 retracement of wave 3. The second wave 4 ends at the 382 retracement of wave 3. Okay, this basically exhibits a tendency I see in markets whenever you're working an impulse wave. The fourth wave move, that counter trend move, tends to balance the, say, proportion and time element. So there's a balance of say, duration, the extent, and time. And sometimes I call this a wall and a floor, okay? Now, what I've observed is that whenever wave 4 is very quick, okay, very short in duration, its retracement of wave 3 is often very deep, going back to the 618 retracement of wave 3. If wave 4 is very time consuming, then it tends to be somewhat shallow, ending at or near the 382 retracement of wave 3. And sometimes it could even be even more shallow, ending at the 0.236 multiple of wave 3. So that fourth wave essentially is a balance of price and time. Whatever we do in time, we don't do in price, and whatever we do in price, we don't do in time. So if you have a very quick, very fast fourth wave move, as exhibited here, then its retracement of wave 3 is going to be deep. If you have a very long-lived wave 4, perhaps say something that you might encounter if you're working a contracting triangle fourth wave, then its retracement of wave 3 is going to be shallow. Okay? Now, this analysis of fourth wave moves being quick or slow or deep or shallow basically argues, well, and going back to certainly yesterday's lesson, how big can a fourth wave get and how short should a fourth wave be? And this kind of goes along the lines of what I identify as the Kennedy timeline. And I'll show you the price chart that basically kind of led me to develop that technique shortly. We're going to be looking at a monthly price chart of Apple. But just a rule of thumb, again, I offer this as a guideline, not a rule, but this is a guideline that I tend to follow in my own Elliott wave counting, is that as far as a minimum duration for a fourth wave, is I want it to last as long, at least as long as wave 2. So that would be the minimum. I'm not going to look for the culmination of wave 4 prior to the duration equality with wave 2. So for example, if wave 2 takes 2 weeks to unfold, then I'm going to be looking for wave 4 to last at least 2 weeks, if not longer. So just because I have a 3-wave decline, following that wave 3 extreme, if the duration element, the time component, is less than a week, I'll most likely identify that 3-wave decline as either, say, wave W of a complex correction or wave A of a possible flat correction. So I do not like to identify a 4th wave extreme that exhibits a shorter duration than what was exhibited in wave 2. So again, if wave 2 lasts 10 trading days, then I want wave 4 to last at least 10 trading days. Okay, that's the minimum. Okay, what's the maximum? Because remember, we don't want to, fall into the trap of identifying, say, a clown shoe wave count and have a wave 4 which is disproportionate to the wave 2. So kind of, again, the rule of thumb I developed for myself, for my own, to help me in my own wave counting, it's kind of akin to something derived from the Pareto principle. What exactly is the Pareto principle? Is that basically 80% of your results come from 20% of your effort. Okay, so I kind of used a variation of the Pareto principle to kind of guide me as far as identifying the maximum duration or length between 4 and 2, and that is basically a 1-to-4 ratio. So, for example, if wave 2 lasts 10 trading days, then the absolute maximum I will allow for a 4th wave move is 40 trading days. So it's 1-to-4 or 2-to-8, okay, 1-to-4. So that gives you an idea of how quick a 4th wave should be and how long a 4th wave should be. So somewhere in the middle between minimum and maximum is where I typically look for wave 4 to terminate. So this whole idea of the Kennedy timeline, and again, it's a very simple technique, but one I kind of identified following doing some in-depth analysis of the Apple price chart. And what you'll notice is I've identified some counter trend moves. The one here in 2008, the one in 2012, the one in 2016, and also the one recently that began back in 2022. What you'll notice is that these counter trend moves are very similar in duration. And again, this was very helpful in identifying, say, applying the Kennedy timeline technique. So what I simply do is I measure the duration of wave 2, and I simply do that as a line, just simply a line from the extreme of wave 1 to the extreme of wave 2. And then I'll take that line and project it or copy it to the extreme of wave 3. So in other words, I will not look for the culmination, the termination of wave 4 on the left side of the horizontal line. I want to see wave 4 end over here. Now there's another technique or a secondary Kennedy timeline I draw, and that would be to the point of recognition. Okay, wave 2 ended at this extreme here. That was our initial KTL, our initial Kennedy timeline. The second one starts at the extreme of wave 1 to the point of recognition. And the point of recognition is simply, once we saw that low, boom, prices exploded upward, or they exploded downward. That's what I recall the point of recognition. So we take another line and copy it up. So essentially what I'm going to be looking for here, again, is I want to see our 4th wave move last just a little bit longer than what you see here. And that's exactly what occurred in Biogen. This is why when we were discussing this price chart on Tuesday, it's an easy count, A, B, C to the downside. Now, these guidelines I'm offering are very, very important because it prevents you from identifying the culmination or the end of wave 4 prior to its actual end. For example, just because you can count a three-wave decline from high to this initial low, you might be thinking that's a fourth wave low and prices are going to continue higher. Well, what happens? Well, prices came down one more time. So if you'd been long here, you would have been stopped out and it would have been very frustrating. With these techniques I'm offering you today, it will prevent you from identifying the culmination or the termination of wave 4 prematurely. Okay, so let's take a look at another example. This was Campbell's soup, which we also looked at Tuesday. So what we're going to do is draw our Kennedy timelines. We're going to draw the initial one, the primary line, again, from the extreme of wave 1 to the extreme of wave 2. And then we're going to draw a secondary line from the extreme of wave 1 to the point of recognition. Okay, and again, the point of recognition is where prices actually began to just fall out of bed or collapse. And then we simply copy those lines. And then this gives me, again, an idea or a window of opportunity to be looking for as far as the culmination of our fourth wave counter trend move. Now in Campbell's soup, again, based off price action, I like the idea that this advance is a fourth wave move and that once complete, it will be more than fully retraced in wave 5. So as you can see by the application of these trend lines, we're now reaching a fourth wave, which is mature. It's ripe. It's ready to be picked, so to speak. So as we trade into the final few weeks of December and to early January, this is kind of our window of opportunity. We have fulfilled the time component of a fourth wave, but we've also too fulfilled the price component of a fourth wave by retracing back to the 382 retracement of wave 3 in this fourth wave price move. Here's another example, and probably the best example that really drives home the idea of the Kennedy timeline. We're going to be looking at a 360-minute price chart of crude oil. Okay, here's our wave 1, here's our wave 2. So to make sure our fourth wave identification is correct, we want wave 4 to last as long as wave 2, no sooner. It can last longer than wave 2, but I don't like it when wave 4 culminates prior in a shorter duration than wave 2 exhibited. And as you can see right there, that's when it was, a perfect proportion time-wise between wave 4 and wave 2. And then following that test, notice where we also too went to the prior fourth wave extreme of 1 lesser degree. So once prices hit that time component and also too the price component of roughly say $80, or actually $79.60, once we saw that, boom, the market came down and it fell down to our 1.382 reverse Fibonacci multiple of wave 4. And I would suspect, based on the price action that we're currently seeing, being able to identify this decline in crude oil as a 5-wave move down for all of wave 1 of a larger impulsive move is actually right on point. But notice again how these techniques that I'm offering again today allow you to avoid the trap of identifying a fourth wave complete before it has really ripened and really hit that appropriate proportional maturity of price and time. Well, that about does it for me for today. I hope you've enjoyed this week's in-depth analysis of impulse wave. I've shown you a lot of tips and tricks which are not in the Elliott Wave Principle book. In fact, I don't even think some of these tips and tricks are in my book, The Visual Guide to Elliott Wave Trading. But these are the things that I personally employ whenever I'm looking at a price chart and counting wave patterns. Next week, we're going to focus on the diagonal. Have a great weekend, and I'll see you next week.